Hey, welcome to the House of AC. I'm AC, and well, this is my house. Time for an exciting topic today. If you're a first time home buyer, whether this is for a primary residence, real estate investment, or you just want some refreshing because it's been a while since you bought a house, this is the show for you today. That's what I'll be covering. I'm just walking you through the basics, the very beginning to end, what to expect, the language that you need to understand, and sort of the steps and the order to do it in. Most people buy a house, stay in the house 5 to 7 years, and I promise you the whole real estate business changes by that time. Within 5 to 7 years, we've got new ways of doing business. Now it's e-signs, new words, and new contracts and new processes, and it's a different market. And when it's a seller's market, it's different than the buyer's market. We're going to cover all those things and what to expect if you are shopping today in this market. Obviously, it's a very, very hot market. And so things may be a little bit different than last time you bought a house. Or if you're just getting into it, you might hear some things and some headlines and think things are scary. And I just want to explain it all and sort of calm the nerves and flatten out the roller coaster ride of buying a house for you. And feel free to ask questions if you're in on the live stream here on YouTube, Facebook, Twitch, Discord, and more. Just go to linktree / the House of AC. To find all those channels. Follow along regardless, whether you're listening to this in your car in a podcast or whatever fashion you're finding this later on the YouTube. Thanks for tuning in. I appreciate it. All your likes, views, comments, questions, whenever you make them, live or later, I'll see them and respond to them. Jasmine Quinetin of Jasmine Mortgage Team and JasmineTeam.com will be joining us later in the show, answer some first-time homebuyer loan questions, mortgage questions. So we're going to cover a lot today, and this might be something that you watch and come back to and listen to later when you're closer to a house hunt, or if you want a refresher reminder. It's this information today probably it will cover more of the basics, and I'll tell you when it's like a seasonal market thing that we're going through, or if this is just sort of a regular thing of doing business. A lot that I'm talking about will be my experience as real estate I've done deals in 4 different states, and it's all very similar. But at the end of the day, you need to have a trusted real estate agent and follow their lead. They're going to be your trusted guide in this process. But I'm getting ahead of myself. That's not even step one to get going on the home improvement. The home buying front. Okay. So what is step one? Step one is understanding what house you can afford. All right. This starts with getting something called a pre-qualification letter from a mortgage lender. Most times you don't want to go to a mortgage lender that does commercials on TV. Chase, Bank of America, Wells Fargo, Quicken, Rocket. They're not going to do a deep dive in your finances and really understand what you can afford or not. They're going to give you a quick pre-Q, which is the nickname for a pre-qualification letter, and it may not hold up. And why this is a problem is you may make an offer. You might think that this is an offer on a mortgage that you can afford, and so you put it in on a house. And then when they kind of do a closer look on your finances, they find credit bill from 3 months ago that you were never aware of, and that's affecting your credit score. Or they say, oh, by the way, we can no longer honor this pre-qualification letter. I don't want you to be caught in that trap where you're now stuck and you fell in love with this house, you made all your plans, you've arranged movers, and then in the last minute, hey, we can't close the loan. So I always recommend, find a trusted mortgage lender. I've partnered with Jasmine Team, Team.com, Jasmine Quinetin, who will be joining us later, like I said. And she's done at least 15 loans for me, probably over 100 loans for my clients. People rave about her, love her. You're going to love her when she joins. It's super easy. Just go to JasmineTeam.com, fill out an application. It's about 15 minutes to fill out. Every mortgage lender wants the same thing. Driver's license, last 2 pay stubs, if you have them ready, last 2 tax returns, and that should do it, and a copy of your driver's license. If you've got those documents ready to go, then she and her team or any mortgage lender can kind of give you an idea of what you can what you can afford. The worst is you think in your head you can afford something. You look at homes in this price point, and then when you come around to getting into and you find some that are attractive, and then when you get around to actually getting a pre-qualification letter, you realize you can't actually afford that. There's, you know, it's very difficult if you're self-employed sometimes, because you have a lot of business expenses that you write off, or if you're an investor, real estate investor, a lot of times if you have an accountant, they're going to make you look like you're a terrible investor to kind of offset some income you're making other places, so you don't have to pay as much taxes. Definitely speak from experience in that point. You probably not qualified as much as you think you are. Most people aren't. And so that's why we always want to start there. And what can also happen in that pre-qualification, which is step one, is a solution for you. So instead, if there is a surprise, you want that surprise early, so you have time to fix it by the time you get around to putting an offer on a house. And it could be, hey, I got to call this medical, bill debt that I've got and close it out and settle it and show proof that I've already paid for it, get it off my credit report. It could be, hey, I got to close off this credit card or pay off this credit card or car note or whatever advice that mortgage lender gives you so that you can get the best rates and afford the house that you want. So yeah, that's one of the biggest wake up calls, the biggest surprise. That all starts at step one, get the pre-qualification letter. Rent interest rates, as you may have learned, are expected to go up this year. They actually went up today, but not enough to like put a cold damper on things. Last week, the average interest rate on a 30-year fix was 3.55%. This week, 3.69%. I mean, we're talking about super low numbers here. Don't freak out. But people are expecting it to get to 4% at the end of the year. Now, I've been saying that for 3 years, but things keep happening, and the government saying we can't raise interest rates because of the economy or coronavirus or whatever. So who knows? But first time I bought a house, interest rates were 8%. I think when my parents first bought a house, it was 15%. So it's been on a decline since the 80s, all the way down to 2.25%. And now we're inking back up to 3.5%. So don't freak out. We're still in a great place. Cheap, easy money. But just know it's expected to go up a little bit. And it's not enough to put a damper on all the bidding wars out there that we're seeing in today's market. And that is also why it's a little bit more important to have your P's and Q's all buttoned up before you make an offer, because if you're trying to compete against an all cash offer or multiple offers, you're going to want to have your offer look really strong. And one way you can do that is having a button up pre-qualification letter. I know Jasmine team in certain situations, you can get her all the documents she needs so that you can actually close in 15 days. Most cash offers can only close in 15 days because that's how long it takes to get a title back. So now you're competing with all cash offers. And so you just want to get all that stuff up ahead so that you have a super strong offer. You don't have to worry about finances. And this is the catch for every new home buyer. Once you get your pre-qualification letter, do not open a credit card, because that now changes all the calculations, even if you don't use it, but you just open up shopping credit card. Now you've got $5,000 credit line that you haven't used yet, but it does throw off all your numbers in your calculations. So don't do that. Don't go buy a new car. Don't go buy a boat. Don't do anything that's debt related or installment loan, a huge subscription service of some sort, because all that's going to change your debt to income ratio, which is a big component of getting your offer pre-qualified. So, it's happened. I've seen deals fall apart day before closing because someone went to go celebrate and bought a new car. So every realtor has a story like that. Okay, and that brings me to step two. Once you get your pre-qualification letter, now you got all your credit wrinkles ironed out. You've worked through all the hoops, or you realize there are no hoops. You've got a number that you can shoot for, and that number, if someone says you can buy an $800,000 house, that I'm not telling you to go buy an $800,000 house. I like to do the opposite. You tell the mortgage lender or Jasmine, hey, I only want to spend $2,500 a month. What house can I afford? And they'll reverse engineer it for you and say, well, if that's the case, if you're comfortable spending $2,500 a month on your mortgage payment, then this is the house that you can afford, and this is the down payment that you need, and this is what the closing costs are going to be. So that is how I approach figuring out what house you can afford. What are you comfortable paying? And that's definitely for the primary residence aspect. For a real estate investment, you want as much money as possible, because any real estate investment you go into is that I would recommend that you buy on. The rental income is going to cover the entire mortgage note, plus the insurance and repairs and maintenance and vacancies and all that. So yeah, the bigger the better on the real estate angle. Okay, so you've got that. Now you need a real estate agent. Okay, I've got a real estate agent team. Go to alancorey.com if you're in the Georgia, Metro Atlanta area. We cover everywhere. ITP, OTP in the Atlanta area. But if you're not, I'm happy to help you find an agent. They're agent referral programs all the time, and I can find people I trust and recommend all over the United States. But you probably also have connections to a real estate agent. Maybe a friend's used one and raved about them and whatnot. A real estate agent is definitely necessary in a hot, crazy market like this. I would say it's even more necessary. As someone who's getting offers on listings, the person who comes to me and says, I don't have a real estate agent, I instantly think, okay, this person's going to be trouble. They probably aren't pre-qualified, or if they are, they didn't use a lender that's trusted. And so I can't trust the pre-qualification letter. They haven't been coached on what I'm about to coach you in this entire show. What's expected in an inspection, what the language is, and the due diligence and the appraisal contingencies and the financing contingencies, all that stuff is difficult for me now to talk to that client, because what I'm doing is I'm explaining what's in the contract, and then I'm negotiating with that person. And there's just no trust there. They think I'm trying to take advantage of them, when in fact I'm trying to teach them. And then now that I've taught them, now we got to negotiate. It creates a difficult dynamic. So I would say you need to bring a real estate agent into this deal if you want a chance at this bidding war. So anyone who's trying to take shortcuts without a real estate agent, I don't think it's going to work for you. I don't. I'd always encourage you to bring an agent with you and be representative. And they're going to, you don't have to pay for them, but that's what's great. If you're buying a house, you're not paying for the real estate agent representing you and helping you buy a house. The seller pays both real estate agents. So just know that's the case. So you might as well use one. And I recommend using one of the top, someone who's in the top 10% of the city that you live in, because they're probably doing it full time. They've got experience. They're going to find off-market deals. They probably know all the other players in town, and they probably got their head on their shoulders pretty tight. So that would be my recommendation. I know everyone has a friend that's a new agent, and this is not the market for that. You don't want a new agent in a hot bidding war market. It's going to be difficult to win a deal. That's just how it is. All right. Okay. So now you found a real estate. You got pre-qualification, step 1. 2, you got a real estate agent that you trust through recommendations and referrals. If you want some advice, maybe how to vet a real estate agent, it's a personality match. It's someone that does a lot of business in the zip code that you're looking in. You can look on Zillow, the MLS, things like that, to realtor.com. Who are the agents that are doing deals in your zip code? If you already live there, you probably see the same signs over and over again. Those are always going to be a safe bet. Okay. Now that you've got that, now you've got your team, right? Because it's not just a real estate agent that's going to get a deal done. It's not just a mortgage lender that's going to get a deal done. It's going to be a team. So that now is your team, and you've been prepped on finances, which is biggest component of it. Now you're going to be prepped on finding the houses and how your market's working and how fast you got to move. Depending on the product type that you're looking at, whether it's townhomes or multifamilies or single families, apartments, condos, flats, it all could have a little bit of nuance to it. your real estate agent is going to hold your hand there. And what to do. Let's say you find a house and you love it. All right. And in today's market, you basically have to make a move within 24 hours if you want a shot at something. But if you see something on the market that's been on the market for 2 weeks, 3 weeks, there's something wrong with the property, or it's way overpriced, or it's under contract and they haven't changed it as such. But that's not always the case. That's just what's happening in this market. So what's in an offer? So when you make an offer, this is what happens. You put in some variables. First one is obviously purchase price, and that's great. Not always does the highest purchase price get you the house, because there's other components and other values and variables in a contract that determine the strength of the offer. Your real estate agent will probably suss out what's important to the seller. Sometimes the seller will say purchase price is most important. Sometimes it'll say closing date. Sometimes it'll say a mortgage lender I know, or I want to close in 2 weeks and be able to stay in the house 30 days after closing. I want a 70-day close, or whatever. Like, all these different things make an offer more attractive depending on the seller's needs. So it's not one solution here. It's determined by the seller at that time. So purchase price is one thing that goes in that offer, and then earnest money is second thing that goes in that offer. It's also called sort of escrow in some states. But what that's basically saying is I'm putting in an offer, and it's an earnest offer, and I'm going to back it up with some money. Depending on your market, sometimes this is as low as 1%, 2%. I've seen 5%. I've seen 10%. I've even put 100% earnest money down before in order to win a deal. But what that is basically saying, hey, here's a chunk of money, and if I follow through with this contract, I get this money back, or this money gets applied to the purchasing of the house. And so I'm going to walk you through the rest of what's in the contract, but basically saying, hey, I'm telling you I'm going to close in 30 days. And if I close in 30 days, then this money applies for the contract. And if I back out, however, per the terms of the offer that I'm presenting to you, where I'm going to have opportunities to back out of the contract, then I get this money back. So it's basically just saying, here's some money. If I don't follow the rules that I'm proposing in this contract, you get the money. If I do follow the rules that I've proposed in this contract, I get the money. And so it's really safe to put earnest money down, as long as you're legit about buying this home and you follow the rules. And I'm going to keep explaining those rules. The main rule on that is called the due diligence period, also called an inspection period. And what basically this says is, hey, I've only walked through your home, or I've seen some homes on the photos. I'm not an expert contractor. I'm not an expert roofer. I haven't gotten all dusty in your crawl space, but I want to make an offer on your home, assuming all that's great. But I do want a due diligence period. And during the due diligence period, I'm going to do a deeper dive. And so what that period can be, I've seen, 5 days, 7 days, 14 days, 30 days. Your realtor is going to hold your hand here. In a hot market, I've also seen 0 days, which says we don't want a due diligence period. We're going to buy our house no matter what. And if we don't, we're going to forfeit this earnest money. But most cases, there's at least 3 to 5 day due diligence period. Then what happens is you get to do a deeper dive in that house during the due diligence period. You get your inspectors in there and contractors and experts. And then you get all this information over the next 3 days. And now you have more information about the house. And then you can go renegotiate during this due diligence period. And if you don't come to terms during the due diligence period, you can back out for any reason. And in most cases, you have to talk to your real estate agent depending on your city and state. But most cases, you don't even have to give a reason. You could just be like, I got cold feet, or I found another house that I like, or I'm just scared of these repairs, kind of thing. But most cases, whatever you find in that inspection report, which is probably a $500 to $600 fee, they're going to give you a 40-page PDF of everything that's right and wrong with your home. Typically, you can go renegotiate at that point because you've got information. And typically, you're going to negotiate at least $600 off, which was the cost of the report. So you might as well do it and get your money. And every house has 40 pages of stuff. Okay. Don't be afraid. Don't be scared of this. New construction homes, they're still going to find 40 pages of stuff. No house is perfect. It's impossible to be perfect. It doesn't mean it's unsafe. It's just, hey, this could be better is usually what's in the report. Okay. Um, and I promise you, anything that's found is a money solution. So if there's a foundation issue, there's mold, there's, all these things that probably scare you, it's a money solution. Doesn't mean it comes from you. If you find terrible things in that inspection report, guess what? The next buyer is going to find terrible things in the inspection report, and then the next buyer. And so that seller most likely can't sell that home until this is issued or this is addressed. And so the way a seller can address it is either, hey, okay, we're going to go fix it and pay for it. And we'll put it in the contract that I'm going to fix this prior to closing. Or they can say, okay, this is your problem. We got a quote for $10,000 and we'll just take $10,000 off the price, or we'll credit you $10,000, things like that. So just know that if scary things come out, you have an opportunity to renegotiate during your due diligence period. And then if you back out because you can't come to terms, it's a negotiation. They can say no, and they can say, well, I've got 10 other offers who might not have a problem with it. And that could be true. You can back out and you get your earnest money back. So it's not set in stone, and you haven't lost too much money, just $600 for an inspection report, until you're through that due diligence period. And then once you're through that due diligence period, then your money goes hard. And that means it becomes more difficult to get out of the contract. And it also gets more difficult to get your money back, unless you have some contingencies in this contract. So if you have contingencies in the contract, these are basically says, these are my other get out of jail free cards out of this contract. A popular one is an appraisal contingency. What this get out of the contract card gets you is, hey, I've got X amount of days to get an appraisal done. Typically it's 21 days. I've got X amount of days to get an appraisal done. An appraiser comes out, independent third party ordered by the mortgage lender. And they say, hey, this house is $300,000. I'm going to tell you what it's worth. They may say it's worth $310,000. And that's great. You don't share that with the seller. You just keep that information to yourself. Congratulations. You're buying a house for $300,000 that's worth $310,000. You win. It could be 95% of the time it comes in at $300,000, which is the contract price. Again, nothing to say. We move forward. Great. Now, if it comes in below, let's say it comes in at $290,000. Well, then you can now activate this get out of jail free card. And what that is basically that says, hey, I thought this house was 300. My lender said she'll give me money if it was 300, but it came in at 290. So now I don't want to buy the house. I want to back out of this contract. Give me back my earnest money. As long as you get this appraisal during that time period. Like I said, 21 days is average, but it's all negotiable up front. So I've seen 30 days appraisal. I've seen 5 days appraisal. It's part of the contract that makes it a strong offer is how many days of this appraisal contingency. A lot of people are putting 0 days and saying, I don't even, or not even including an appraisal contingency. But let's assume that situation comes in at 290 and the contract's 300. You do have room to renegotiate before you back out. You can say, hey, seller, I need you to drop the price 290 to move this deal forward. Sometimes that works, and sometimes that gets the deal done. Sometimes they'll say, well, no, I've got 5 offers behind me, and I'm going to try my luck that another appraiser will find a different value for it. You could push back on the appraiser and give them some extra comps. Your real estate agent would help you with this. So if you don't have a real estate agent, very difficult to do, but a real estate agent can also push on the appraiser to revise it or send a second appraiser out there for a different opinion. You got a lot of different options here. Typically, it'll probably settle in the middle. Well, they'll say, seller's like, well, I'll take 5,000 off and you have to bring an extra 5,000 to the table. Let's just bridge the gap somewhere in the middle. Again, it's a negotiation. Who knows which way it's going to go in your situation? You just know that's what an appraisal contingency is. Having it puts the risk on the seller. So it makes for a little bit of weaker contract because now the seller has a little bit of risk on what the appraiser is going to come back with. But if you take off the appraisal contingency, well, now the risk is on the buyer and your offer looks stronger. So things like that really determine the total package of the offer that you're putting in. Another similar one is called financing contingency. This is usually moot because what basically this says is if I don't get approved for a loan in X amount of days, standards 21 days, then also I get my earnest money back. But if you've done all your legwork up front and you could get pre-approved for a loan and you went through the deep dive on your loan approval, then you know that you're going to get approved for a loan. Like you've already done that work before you even looked at homes. And so you could just not even put a financing contingency in the offer because you're confident you can get a loan. The things that could happen though, this is the risk, right? Do you want to put the risk on the seller or do you want to put the risk on yourself? Let's say you lose your job between now and the closing. Let's say you have a major car accident and you have to now go buy a new car and there goes your down payment. Or you have medical bills that wiped out your down payment, or some drastic things. You get a divorce in those next 30 days. You find out some financial hardship is about to happen to you. Well, now, since your finances have changed, and what's changed, you put on your pre-qualification, you want to go buy a boat, you got a new car, you got a new credit card. All those things can drastically change your finances. And so you could get denied for the loan at that point. So if you think that all those things may happen, sure, put a financing contingency in there, which is a very common. I'd say 80% have these things. But then you're putting the risk on the seller to say, oh, hopefully nothing bad happens to you. And that makes for a slightly weaker offer. If you put that risk on yourself and say, I'll take the risk. And if any of those bad things happen, I will forfeit my earnest money. Well, then you put the risk on you and that makes your offer stronger. You want to put all the risk, as much risk as you're comfortable with on the buyer side so that you have a strong offer. Sometimes you can win offers with all these other variables, even though your purchase price is lower than some of the other purchase prices. Because I've seen offers win that had no appraisal and financing contingency, and it was $10,000 less than the highest offer who had those things because they're putting more risk on the seller. All these things to consider. All right. Again, this is why you need a trusted mortgage lender and a trusted realtor on your team advising you through all this stuff. Very difficult to do by yourself. I'm not saying you can't. It's just, it's a little bit harder, especially in a hot seller's market like this. After that, I'm going to cover two more steps, and we're going to bring Jasmine in to answer your questions and also kind of talk to you about the process of getting pre-approved. After that, once say you get through all your contingencies, and there could be other contingencies and there are other negotiations. I'm not going to cover them all, but you could be, I've got to sell my house first before I buy another property. That's another contingency. All these things are where are you putting the risk that on you or on the seller, and that all goes into it, making a strong, good offer. Again, your team, your surrounded expertise team is going to walk you through all these options. After that, let's say you get through all your contingencies. All you got to do is wait, and whatever your lender needs, they're going to need documents. They're going to need updated documents, updated pay stubs, updated investment account statements. If your job's changed, updated salary, and job offers, all this sort of stuff, you just got to get to them as fast as possible. Okay. They're going to ask, and they're going to ask for things, and you're going to say, I've already submitted this, but they need the newest version of it, and they need to refresh all their documents. Who knows when you provided this document 2-3 months ago? Well, they need refreshed checking accounts, refreshed pay stubs, all this stuff. So it's going to feel redundant, but honestly, it's not, and it's necessary. And every lender is going to ask you for it. So it's unavoidable. But the faster you get it back to it, the more likely your closing will close on time. The worst thing would be you've got the movers arranged, the sellers and the buyers, you're all at the closing, and everyone's still waiting on 1 or 2 documents. Avoid that problem, because that's where the stress comes in. That's where people get angry. This is where deals fall apart. Both sides are stressed. Buyers and sellers are always stressed. It's a stressful situation. Moving, you're changing your life. So getting all that paperwork as fast as possible back to whoever needs it, whether it's the closing attorney, things like that, or the mortgage lender. You will be constantly inundated. That's not the word. You know the word I'm trying to think of. To have documents produced, and so just do it up front. It'll make it a little bit easier, and then have it ready for when they're asked for it again. And then you go to the closing table. The closing table is when everyone signs, the buyer signs, the seller signs. Sometimes it's done at the same table at the same time. Sometimes it's done at different points in the day. Sometimes it's done over 2 days. Sometimes it's done online. Every deal is different. But that's where you sign all the paperwork. Your wrist gets tired, or your clicking finger gets tired, clicking all these digital properties. And the closing attorney is going to do everything. This is they're going to make sure the documents get to the mortgage company, the documents get to the buyer, documents get to the seller. Everyone gets all the information. They hand over the keys. Well, you're done. You bought your first house, and then you've got to move, unpack, and move everything forward. But you now are a homeowner. Congratulations. And so that's it in a nutshell. And I want to bring Jasmine in now and talk to her, because she is the first line of every first-time home buyer, and she's going to tell you the current concerns and questions you probably have as a first-time mortgage applicant. And so, hey, Jasmine, thanks for joining the house today.
Thanks for having me, Alan.
So you caught a bit of that recap, and I know you're really familiar with that. What is what other advice that maybe I miss out on first-time home buyers? Maybe some concerns that they have, things like that.
I mean, for me, I think first-time home buyers, I would say usually the best way to go about it is to get your ducks in a row ahead of time. And so typically what a lender is going to talk to you about is income, credit, and assets, right? And so as long as you know where your W-2s are, you know where your pay stubs are, that should cover the income piece. Make sure that a lot of times people will keep their credit frozen. So even when you apply for a mortgage, if your credit is frozen, that can be a step that's going to delay you by a day or two. So go ahead and unfreeze your credit when you're ready to apply for a mortgage. Don't buy new things, right? Don't buy a car. Don't even while you're in the process, right? So just kind of keep your credit very, very same. Like don't add things, don't take things away. I had a client one time who was like super type A personality, overachiever. She came to me with an 800 credit score when we started a loan. She was pre-approved. Everything was wonderful. And then she decided that she wanted to look even better to the underwriter. So she went and closed every single trade line on her credit report while we were trying to do her loan. And all of a sudden I got a notification like, hey, her credit score dropped to 623. And I was like, girl, what did you do? And it turns out she was just being like a super overachiever. So she just totally paid off everything and then messed up her credit score. So don't do anything that you think is going to be helpful. Like if you have credit, if you have collections in your credit, right, don't try to pay them off. Let me pull your credit. And then we have software that we use in the background that'll kind of analyze your credit, and it'll automatically notify me, like say, hey, there is a possibility for this borrower to improve their credit score by 20 points. They need to do A, B, C, D, right? So wait for me to pull your credit in case you don't know what your credit looks like. And then assets, that's one of the things that, you've got to have some money for a down payment. If you're a first-time home buyer, the minimum down payment is going to be about 3%. And here in Georgia, you also need to pay for your own closing costs these days. You probably mentioned that the sellers are not offering much in the way of closing cost credit. So I would also budget that you need to have another 3 to 3.5% set aside for closing costs. So really you need to have about 6% of the purchase price set aside in your assets.
No, I'm glad you brought that up. So there's the down payment for the loan, 3%, 3.5%. It's typically the lowest. And I usually typically blanket advice, not for everyone, but mostly blanket advice, put down as little as possible. Lock in these really low interest rates for long term. It's going to be in your best financial interest. But the closing cost is another 3.5%. That goes to the cost of getting a mortgage, the cost of the closing attorney, the cost of recording it, with the government, public files. That's not realtor costs. Those are just the cost of doing business and buying a house. So that's a good thing to point out. And also you mentioned about having all these documents, having your W-2s ready, tax returns, driver's license. I would recommend create a folder on your computer, maybe it's a shareable folder. Just start putting all those documents in there now, so you don't have to hunt and peck for it later, because it's always going to be in between meetings while you're at work. They're going to need some document quickly. And you just want to have it ready. And so it's very helpful for you and for everyone around you. Keep the well-oiled machine.
Yeah, we always kind of joke, internal, we always joke, we've got the clients that know where their W-2s are, and then we got the clients that don't know what a W-2 is, right? And so just familiarize yourself, like you've got your tax returns, you've got your W-2s, you've got your 1099s, do a quick little income crash course. But yeah, it doesn't have to be a lot or complicated, but I find that the hardest thing for first-time home buyers is that there is like this, there's like almost like this barrier to entry, and part of it is like, okay, we don't have the money saved up, or we don't have good credit, but also a part of it is just this fear that people have, like, oh, I've got interesting income, or I've been I'm a freelancer, or I work in the movie industry, and people, it's really hard to get mortgages. I find that it's super helpful to have a chat with someone, because if you do, then you're not going to be sitting on the sidelines with your head in the sand thinking like, oh, I don't think I can do this. Because even if it's not now, we will come up with a plan. And then, in 6 months, maybe you need to pay a couple things off, or maybe you need to change how you get paid, or, maybe you need a slightly higher income job, or whatever it is that we need to switch around. But we can typically get most people there in, 6 months, maybe a year. If there is like really big problems with credit or something like that, it's going to take some time. So I feel like the sooner you figure out what your baseline is and what you need to work on, and get out of the confused headspace where you're like, I don't know. The sooner you make the decision, like, hey, let me do this, let me actually talk to somebody, the quicker you're going to be able to buy your first home.
Yep. And this everyone has in their head, don't get a credit pull. This is going to ruin your credit, ruin your chances to buy the house. Can you kind of settle that debate once for all? When should they do a hard credit pull, soft credit pull? Should they not? At what point? Any advice there?
Yeah. So I think that you need to have a lender pull your credit just so you know where you stand. And to get an actual pre-approval, you're going to have a hard credit pull. But let's say that you're in a situation where you know that your credit scores are not at the minimum threshold for loans, which is around a 580 credit score right now. So if you know that your credit score is 560, that's a situation where I would maybe suggest doing a soft pull, where it's not an actual credit pull, so it won't ding your credit by a few points. When somebody pulls your credit, it's always going to drag down your credit score by a few points, right? So that's why we suggest do not have a bunch of people pull your credit at the same time. Like, don't go like and call 3, 8, 10 mortgage banks to get shop for rates or whatnot. Like, just find your person, the person that's going to be part of your team, that's going to get you to the closing table, and let them pull your credit. So that if you're going to be doing any shopping around or feeling around, you can do that. That is fine, but don't have everybody pull your credit. And then that would be a hard credit pull. And once we pull your credit, the assumption is that credit report or that credit pull is valid for 4 months. So hopefully within that 4-month window, you're going to be able to you're going to find a home, get it under contract, and we're going to get closed with just that single credit pull. And that's going to maybe affect your credit rating by a few points. But if you have a bunch of different lenders pull your credit every 2, 3, 4 weeks, you see how that can add up. Because if you started at a 700 credit score and then you have 10 people pull your credit, you could be like at a 650 credit score by the time everybody is done. So I would suggest just minimize your credit score pulse, but don't be like frightened that it's going to ruin your chances of ever getting a home just because somebody's pulling your credit.
I think your advice aligns with mine. I'd rather have that credit pull up early before you even start your house hunt. Let's dig deep. Let's get your pre-qualification. Let's really understand your finances so you don't have a surprise later on.
Yeah.
And if you're listening to this, Jasmine, you're licensed in 48 states, everything but New York and Hawaii. Is that correct?
Yep, absolutely.
Okay. Yeah. JasmineTeam.com is a great website there. Just get started. So when someone reaches out to you for the first time, how long does that process take? Is they need to take an hour lunch break, something like that, to work through this?
Yeah, absolutely. So the actual application online shouldn't take you about 15 or 20 minutes. The information that you need to know is like date of birth, social security number, where you've lived for the last 2 years, um, where you've worked for the last 2 years. It's pretty simple. You can just kind of fire through it. And then once we get the application, we're going to pull your credit. We're going to do a verification of income. A lot of this stuff is automated through the work number and so forth. And then we're going to submit it to Fannie Mae and Freddie Mac for an automated approval. And then we're going to get back to you and say, okay, we've got our approval. Here's the lay of the land. We've got approved for $350,000 with 3% down. This is what your monthly payment is going to look like. So from the time you submit the application to the time we typically have you pre-approved is less than a day. Most of the time it's same day. If your finances are a little bit more complicated, if you own, 4 or 5 different businesses, there's tax returns, business tax returns, K-1s, that can take an extra day or two to crunch through just because there are so many pieces of information that we need to hunt down. But if you're just a regular, if you're just a W-2 employee paid on a salary, those pre-approvals, those are done just within a couple hours.
Okay. And then, so I started the episode talking about how the interest rates went up a little bit today. What's your advice? When can you, let's call it a rate lock, where you get to lock in your interest rate? At what stage does that happen?
Yeah. So typically we lock in the interest rates once you have a home under contract.
Under contract. Okay.
Yes. So right now is an interesting time because the interest rates have been going up literally every single week. I feel like it was just a handful of days ago that we were in the low 3s. Now we're in the high 3s. By the time today is done, we may actually start talking about 4s. And so rates are just like doing this thing. The Fed's meeting in March. We're expecting interest rates to go up. So if I had to guess, we're probably going to be in the mid 4s before too long. So we have a program that we do that's called Lock and Shop. And so essentially we can lock in an interest rate for up to 90 days, even if we don't have a property picked out. Oh. And so typically I haven't been using the Lock and Shop because for the last couple of years, give or take an eighth of a point this way or that way, it hasn't been something that I have been utilizing for my clients. But in this particular market, so let's say that the interest rate today is 3.75 with $1,000 in fees, just to make it simple. If we do the Lock and Shop, the interest rate is going to be about an eighth of a point higher. Right. But we're going to be locked for the next 90 days. And we know that over the next 90 days, interest rates could go up by a half a point or more. So I would advise, if you are just getting into it, if you think like, hey, I'm going to be buying something over the next 3 months, I would suggest doing our Lock and Shop program, just because we're in a different market and interest rates are just kind of funky right now.
So a standard home that you get under contract, typically it takes 30 days to close on that loan, just the process of going through the mortgage, get appraisers out there, inspections, moving trucks, things like that. Yeah. Are you still seeing that happening as well?
Yes, that's 30 days is pretty common. And we have had to get a little bit more aggressive because there is so many offers on the table, kind of like you were talking about. I have seen things like 2-day due diligence and, tens of thousands of dollars in earnest money just to make the offer as strong as we can. And sometimes it is important to the seller that they close as quickly as possible, right? And so in case we have a situation where you guys are trying to make a competitive offer and the seller is asking for a 2-week close, we can accommodate those rushes. And so we're just like everybody else. I mean, real estate agents are struggling a little bit with inventory because there isn't that many homes available. And we, as your lending partners, are trying to do everything we can on our end to make sure that we're moving as quickly as we can, getting the rush appraisals and helping you look as good as possible to the seller with your offer. So it's an interesting time, but it's still a real, you talk about investing all the time, right? And to me, it's still the safest place to park your money. So yeah, it's a good idea.
Well, that's good. Well, it's I think there's sometimes overwhelming options when you get a loan. There's something called an ARM, which is adjustable rate mortgage, where your interest rate changes. There's fixed options, which means it'll never change, but there's a 15-year fix, there's a 30-year fix. Any sort of recommendations and things that you see for first-time home buyers or first-time real estate investors?
Yeah, I mean, I am a true believer in the 30-year fixed product. That I would say 98% of everything I have ever closed has always been a 30-year fixed. It's over the longest period of time. You're going to lock in the interest rate. If the interest rates go up into the 4.5s and 5s, it is possible that maybe there is going to become more of a need for ARMs. Right now, ARM rates, adjustable rate mortgages, have been just an ooch cheaper. Like if you could lock up a 30-year loan a couple months ago at 3%, you would have locked maybe a 5 or a 7-year ARM at like 2.5. So yes, it's a little bit better, but still not worth it, because you could get a 3% rate for 30 years, right? But as the interest rates start on the fixed rate mortgages start going up, the ARMs will usually stay lower. And so sometimes we may get back into an environment where ARMs become a little bit more attractive. But for right now, I'm still just 30-year fixed all the way is my
the last housing crash was created by ARMs. Basically, everyone's interest rate got readjusted at the same time, and obviously, when your interest rate goes up, your mortgage payment goes up, and that can make things really tight, and people start foreclosing. So an ARM is a great opportunity. Also, if you're only going to own the house for 5 years, because basically an ARM says if you have a 5-year ARM or a 7-year ARM, basically it says in 5 years or 7 years you have to pay off this loan in full or refinance. Mm-hmm. The way I look at it, I echo your sentiments. A 30-year fixed is great because then you don't ever have to refinance. The only time you would ever refinance is if the rates go really low. But the chances are that going much lower than high 3s in the next 30 years are probably pretty low. I think they're either going to plateau or always be inching up a little bit. If you just want the risk-free option, also 30-year fixed means your payments are spread out over 30 years instead of 15 years. So it's also going to be the cheapest payment that you're going to have, which is you always want to have the cheapest payment as possible. So might as well drag that out over 30 years. And so if you lose your job or things get tight or you want to save some extra money for something else, well, obviously the lower monthly payment is going to help you accelerate all those other goals you may have.
Mm-hmm. Yeah, and it's a 30-year fixed mortgage that's going to have no prepayment penalty, no balloon payments. So that just means that if you wanted to be an overachiever and put some extra money towards your monthly payment every month, you can. It's just going to be paying off your principal faster. So, but I prefer that to a 15-year fixed. I know that you pay a lot less interest over a 15-year loan. That is a fact. I agree. That's a great idea. But I also think, especially if this is your first home and maybe you still have another 20 or 30 years until it's time to retire, I think that extra money could be well invested somewhere else versus, paying, 0.5% less on your mortgage, which is what you would achieve with a 15-year. And 15 years are tough. Like I had a client one time that was, she had a lot of equity in her home. And we had done a 15-year mortgage for her. And then this was through the last crash. What had happened is that she had lost her job. She had gotten behind on some of her bills. And so her credit score dropped. And so at that point, without a job and with a low credit score, it was impossible for her to refinance back to a 30-year. And so essentially her only option to get caught up was to sell that home, which was not a great idea back in 2008, 2009. But she had, several $100,000 worth of equity locked up in her house because she was paying, while she had the job, she was paying extra on her 15-year mortgage. So she had a $180,000 mortgage on a $700,000 property, and she did not have a job. She did not have money to pay her bills, yet she had $600,000 worth of equity locked up in her house.
Right.
So it was a tough situation. And that was a pivotal moment for me as well as a mortgage advisor, because I was like, hey, so much less interest, 15 years, go, go, go. And then in that situation, I was like, that would have made a huge difference for her, because her monthly payment on a 30-year note versus a 15-year note would have been about $1,000 or $1,200 less. And when you lose your job, having an extra $1,200 a month, that $1,200 fewer in bills, right? That's a big deal.
Right.
And so you kind of have to plan for these things while things are good. Like while you have the perfect credit, while you have the good job, set yourself up. So if something bad happens in the future, that you have thought through your financial plan. And that's why I'm a huge believer in the 30-year note. If you want to pay it off sooner, have fun. There's no prepayment penalty. That's fine. But don't put yourself in a position where you're going to have to sell your home, maybe at a less of an opportune time just because you're forced to sell.
Yeah, that makes complete sense. So if people are listening today and they want to get pre-qualified, pre-approved through your website, jasmineteam.com, how much does that, it takes 15, 20 minutes to fill out, and then maybe an hour in total once you supply all the documents after the fact.
Yeah.
How much does that cost to just talk to you and get that pre-qualification letter?
There is no cost. That is a free consultation. We don't even charge an application fee or a credit report fee. There's no fees to you as a borrower. We take care of, we shoulder the cost, and we get you pre-approved, and then we get you out shopping. So definitely do it. It's easy. You can fill out the app on your phone, on your lunch break. It's not complicated, and let's just start a conversation, and then we can lay out a plan and make sure that you get into the home ownership game quickly.
Yeah, no, I love this. That's how we cross paths. As a real estate investor, we started talking, and you provided me strategies. You do this for first-time home buyers. This is the strategy to get you the cheapest deal. Hey, pay off this credit card, or let's get one more tax return under your belt. Let's wait a month and until that's processed. You give advice like that, which is different than I've seen from other mortgage brokers. You told me, hey, if you want to acquire 10 more properties, do X, Y, Z. Set it up this way. Let's include your wife on this loan. Let's not. Whatever the situation is for your personal finances, it's like a free financial consulting from you. So I that's why I always sing your praises. So if you're anyone listening out there, you get more than just a pre-qualification letter from Jasmine. So you and your team do a great job at that.
Yeah. So one of the benefits of having been doing this for a couple decades is that, every year I talk to thousands of people that are looking. So I have pretty much crunched just about every scenario, thought through just about every possible loophole. So there are very few things that you can throw at me that I have not worked through with an underwriter. So yeah, I love helping. For me, it's always my dad is an engineer, and so I kind of naturally come at it from a little bit of an engineering mindset. Like for me, it's always a puzzle that I'm solving, right? And so you can come to me and say, what can I do? And then, within that 15, 20-minute consultation, I will let you know if you need to have your grandma add you to her Amex, or if you can add your mom to the loan, or if you need to pay this down and do this with a car. And I'll come up with a patchwork of options for you to ponder and set up your game plan to get into a home. But first-time home buyers are my first love always. My favorite thing to do is helping young people get into homes. That's what I live for. That's my drive. I still remember this one girl a few years back. She was young. She was barely in her 20s, working her first job. And she came to my office and we had our consultation. And by the end of the consultation, she was pre-approved, and she sat there, holding her letter, and she started crying. And she's like, I can't believe that I'm actually sitting in an actual real mortgage office with an actual pre-approval to buy my first home. And I was like, oh my God, just, I love it. I love it so much.
You feel like an adult when that happens. For
it's
the
a
first
huge
time.
thing.
Like
it's a huge
wow,
thing.
wow, I'm an adult. Yes.
Yes, I love it.
We all get there at different stages in our life. So
you don't have to be young.
Yeah,
you
there's
don't
no
have to
race.
be young.
There's no race.
Exactly.
Okay, well, thanks so much for joining the House of AC. Jasmine, appreciate it. It's always a pleasure having you on the show. I actually get the most views on my show when you're here, so maybe I should have you back more often.
Maybe I'll just hang out with you here every day.
Yeah, I appreciate it. Everyone listening, please, thank you. Like and subscribe, whatever platform you're watching this on. Give me online reviews, feedback, questions, all that. It really helps me keep this going and bringing you content that you enjoy. We'll see you next time. We live stream daily, and so that means I'll see you tomorrow. Thanks, guys, for tuning in.